Denver's housing market isn't just slowing down, it's actually splitting in two. On one side, homes under 600,000 are flying off the shelf. And on the other, anything over 700,000 is sitting for weeks, even months. In today's update, I'll walk you through the numbers driving this split: inventory, price cuts, and days on market. Then I'll break down exactly what it means for buyers and sellers on both sides of the divide, and the strategies that you'll need to win this fall. If you're new here, my name is Landon. I'm a local realtor here in Denver, and I help people find the right home in the right neighborhood, whether you're buying your first place or your forever home. But first, let's zoom out and look at the big picture that's creating this two-speed market. Okay, so first off, we're gonna look at the big picture of what's actually happening in this market. First, inventory. It's actually surged since spring of last year when we had 6,000 homes on the market. Right now we have 13,000 homes on the market, and especially in homes priced at 700,000, that's where our inventory has gone up the most. Approximately 38% of all listings in Denver are seeing price cuts right now, which is actually the highest rate in the nation, according to Resi Club. And Resi Club looks at over 400 markets in the US. Denver's #1, okay? Along with Phoenix, Salt Lake City, and a few others topping the top 10 chart, when those used to be the hottest markets for a decade and the fastest growing markets. Now those are the markets that are struggling the most as far as, price cuts go and having multiple price reductions a lot of times before homes sell. The other big factor is days on market. We just hit 52 days on market in July. It's the longest average time on market for any July that we've had in the last decade, since 2011. And so single family home prices have held relatively steady year over year, just 1% down, but condo prices are down between 6 and 7% in most cases. Also, current mortgage rates are hovering right around 6.5% right now. It's creating a small window of opportunity for buyers when they dip, and it looks like they're continuing to go in that direction. The days of listing a home on Thursday and being under contract by Sunday are for the most part gone. This slowdown is giving buyers leverage that they haven't had in a long time. But as you're about to see, this reality doesn't apply to everyone equally. This is where things get interesting, because the 52-day average is misleading. Let's break down the first half of the market, the fast lane. So this segment of the market is the 600,000 and below segment of single family homes. Okay, we're not talking about townhomes or condos right now, but the homes that are under 600,000 or right around there seem to be what we're selling the most of right now. It's amazing because a couple things are true, right? If you ask who is buying these types of homes, you would say, a lot of people who can afford single family housing now can afford less housing than they could before when interest rates were so low. And so because of that higher interest rate payment and, the average payment being around between $4,000 and $5,000 right now for a single family home, they're keeping it to a minimum and living with a little tighter quarters right now so that they can keep their payment on track with their budget. So oftentimes this could be someone who's moving from a townhouse or condo into a single family home. It could also be first-time home buyers that are buying these homes. Also, it could be investors that are interested in these homes as well. And therefore, because there are so many people converging on this type of property, there's still a supply shortage in this tier only. We have seen multiple offers that are happening on these types of homes as well, especially when they're done up nice with updates. They win the emotional appeal award, and they list at a price that makes sense. A lot of times they go in the first 2 weekends, and you may have multiple people that are interested in them. So if you're a seller who has a home in this price category, you're in luck, because you're one of the only price points right now that is really a good price point to be in. And I would just suggest pricing it aggressively, maybe right at where comps are, or maybe 1% below, just so that you can attract a lot of people. And the listings that I see that price low in that category get driven up based on market competition. So it's a very safe place to list a home right now. And it's also one where, prepping your home absolutely matters still. The tired ones that are going on for price too high are still sitting these days. So you still have to be fundamentally on it as far as, prepping your home and pricing it right. But Yeah, it's a great time to do that and still list a home, especially in that fall window between mid-September to mid-November. So if you're looking at single family homes under the $600,000 mark, it can feel like the last 2 years never ended. This part of the market is still moving fairly quickly. The reason is simple. A massive pool of buyers are all competing for a very small inventory of homes. Many first-time buyers are desperate to get out of their current renting situation and lock in a payment. Young families are also looking for a yard, and the demand is still incredibly high. So if a clean, well-maintained single-family home hits the market at, say, $575,000 in a decent neighborhood, it's still going to get a lot of attention. Buyers in this bracket know these homes are rare, so they act with urgency. As a seller, this means if you price your home correctly from day one, you can still expect a fast sale. But if you overprice, you risk missing that crucial initial wave of buyer interest. Now, I specifically said single family homes for a reason. There's a catch in the entry-level market that's affecting a lot of properties. That is that condos and townhomes are still slowing down. It's a tough market to be in right now if you're trying to sell one of those. Really fun time to buy one. But you may ask, why are lower priced attached homes not selling as fast? And, I would say the biggest reason is you've got HOA costs that have really gone up. Special assessments, meaning, hailstorms that have created large deductible amounts that HOAs are now charging per owner, saying every owner owns $5,000 in the community, help with the cost of the deductible to replace the roof with insurance. And, it's assumed in these HOA communities that the HOA is covering the cost of replacing the roof. But they do have the right to do a special assessment. So it's just something to be very aware of, and always carry an HO6 insurance policy so that you can be protected from special assessments when they come up. And if you haven't talked about that with your insurance broker and you own a condo or a townhouse, time to make that call and make sure that you're covered before the next hailstorm hits. And we've seen HOA costs go up from $200 a month on average to now it's like $400 to $450 is more the average number for a monthly HOA fee for a lot of these condos. Townhomes tend to be closer to $350 to $400, a little bit better, but still, hefty payments on top of your payment that you're already paying with a higher interest rate now. And so that's why, from an affordability standpoint, when you look at $350,000 condo, you may be looking at a payment that's around $2,700 a month plus an HOA that's $450. Now you're at $3,250 a month. And a lot of people are just saying, you know what, if the payment's going to be that much, I may as well buy a single family home and cut out the costs of the HOA. And so that's why you're seeing a lot more people go that route and maybe save a little bit longer. And so they can get into the market next year or the next year after they've saved a little bit more if they're disciplined. That's one of the trends that we're seeing a lot of, and why these condos and townhomes are rising in inventory. And it's just a more saturated market with the condos and townhomes. It mainly comes down to affordability compared to the jobs and income levels of those types of buyers right now. So if you're looking for a condo or a townhome right now, you can get a great deal. You have a lot of negotiation power. However, one of the things that you should be looking at is the financials for the HOA, taking a deep dive on the reserves that they have. Are they running out of funds, or do they have a few $100,000 sitting in the coffers just in case a hailstorm comes and they have to pay a larger deductible? Do they have a good insurance policy? A lot of these HOAs, they're hiking up their deductibles to 10%, or more. And if they do that, a lot of times it eliminates the ability for someone to get conventional financing in the community, which is a huge problem. If people can't get financing to buy these condos and townhomes because of the master insurance policy that the HOA put together, then that creates a big problem. That makes appreciation stagnate a ton. And a lot of people will tend to, drift in their value because your buying pool just shrunk if people that need to get a loan can't get a loan in the community anymore. If it just comes down to cash buyers, that's like having a non-warrantable condo or townhome community that makes it so that it's a big struggle. Also, I would pay attention if you're buying a condo or a townhome. Look around the community. Does it look like it's in good shape? Does it look like it needs a facelift? Do you have rotting wood on all the decks? Is the paint peeling? Does the roof look like it has a dozen pelts all over the place? Those are all things that are really important, when you're looking around. If you don't get a good vibe with the community, then it may not be the best purchase to make. But if it looks like the association's all over it, they're making fixes happen, it doesn't look like it's run down at all, then that's probably a good sign that they're in good shape financially, that they have reserves, that they have a good insurance policy for the community, and they're not putting all of their owners at risk of special assessments and further damage by not taking care of rotted wood. That can lead to mold and a lot of water issues and stuff like that. So if you have an HOA that's not on top of things, it can get worse before it gets better. Also, on top of all of this, rising insurance costs are a big thing that these HOAs are facing right now. So these master policies have gone up significantly, and some of them have the money to pay for the policy and they're fine. But others have tried to cut corners and they get a way less expensive policy with a much higher deductible that puts all the owners at a much higher risk of special assessments. And then the personal insurance for the inside of the building that you have to provide coverage for as the homeowner if you have a mortgage, that insurance has gone up quite a bit too. And so again, it's just all the costs involved right now with condos and townhomes that are making those a little more expensive. However, prices have come down 7% in the last year. So on average, that's around a $35,000 decrease in pricing, making it more affordable. Not to mention, there's a lot of motivated sellers right now in the condo and townhome world. And so if you make an offer that's lower, they may just be very excited to get an offer at this point and come down even more and pay for closing costs, pay for rate buy downs, sweeten the deal for you quite a bit. Here's a critical note that many people are missing. While entry-level houses are selling fast, entry-level condos and townhomes are a different story. The risk of a surprise 5-figure bill is just too high, especially when combined with already rising monthly HOA dues. So while these properties look affordable on paper, their hidden risks are pushing many buyers back toward the single-family market. This caution from condo buyers is a perfect lead into the other side of the market, where buyers are showing extreme sensitivity to price and risk. But first, if you're finding this breakdown useful, make sure to hit that subscribe button, as I share market updates like this every week so that you can stay ahead of the curve in Denver real estate. So we talked about the fast lane, now let's look at the slowdown. This slowdown that we're talking about is happening in homes that are over $700,000 in the Denver market. And you may ask, why is the higher end of the market cooling down so hard? One of the biggest things to think about is you look back at the span of low interest rates, you guys. Like ever since 2008 happened and the recession began and rates plummeted down from 6.5% all the way down to, between 3 and 4% during that time frame. And they hovered between 2.25% all the way up to about 4.5% for about 15 years, which is crazy, right? 2008 all the way to 2022, we had crazy low, historically low interest rates. And so because of that, you have a big portion of homeowners that already own homes in the market holding on to their low rates so that their payment doesn't go up, but they don't pay a ton more interest, right? Now, some of those owners, they needed their equity out of their home, so they cashed out and now they've got a higher interest rate payment, but they fulfilled a life need. It may have been a bigger home because they'd had another kid. It may have been a move based on location or a job change. It may have been a downsized move because they've had kids leave the house and they don't want to pay for all the utilities and all the space and clean the whole house, that sort of thing, right? And some of these homeowners, keep in mind that, about 30% of all of the homeowners in the market in Denver are free and clear of any payment. And so those people are making decisions on a different level than everybody that's thinking about interest rates right now. So to that point, I believe that there's a lot of pent-up demand. A lot of people who would like to make a move to a different sized home or a different location of home, but they're still waiting because of financial reasons. It's all based on affordability. And so because of that, there's that 700 and up range tends to be that tier where we're not seeing as many move up buyers. And when you don't have move up buyers in your market, then it's not an even distribution. Every price range is not growing together, right? You have that lower end price that's growing up, and then you've got a little more stagnant $750 to $1 million price point and beyond. Therefore, buyers in this price range are definitely more sensitive to interest rates because they've had an interest rate locked in for much lower for so long. And so it's a big jump for them. Or a first-time home buyer who's looking at rates today, they're going to look into their payment for the first time and not compare it to anything before until they talk to their parents and their grandparents. And I've talked to several sellers and I've represented several sellers in this price point. And it's one of the most challenging price points to be in right now. A lot of sellers are just wondering, like, where are the buyers? Other sellers are getting showings because their home looks great online and they have great pictures and marketing, but they're asking the question, why are buyers being so selective right now, right? Why are we getting so many showings but no offers? Why isn't anyone pulling the trigger? And it just seems like a lot of buyers are slow on the trigger because of those financial reasons. And the solution for them is, yeah, we'll move if it's the right fit, if it makes sense, but it really has to make sense. And in a lot of cases, for some people, it just hasn't made sense yet. Once you cross the $700,000 threshold, you enter a completely different world. This is where the market has hit the brakes hard. Buyers in this range are extremely cautious right now. We're seeing homes in this tier sit for months with very few showings. Sellers that are not motivated are holding firm on their price, thinking back to the offers that they could have gotten a year ago. But the market has shifted, and the buyers have the leverage now. If a home isn't perfectly prepared, staged, and priced with pinpoint accuracy, buyers will simply move on to the next one. This has become a buyer's market, but only if the seller is actually ready to sell. So we have these two completely different scenarios playing out. Why? What is the fundamental reason for this dramatic split? Interest rates absolutely have a big responsibility here. So the higher your loan amount is, the more the interest rate actually matters. And so that's why we're seeing that upper end sit a little bit longer. There are a lot of cash buyers and just cash in our market in general, surprisingly. For those people, it doesn't really matter. But for the ones who are getting a loan and borrowing a significant amount, say 80 to 90% down on those higher priced homes, that's a big chunk of money that they're paying in interest. And for some reason, that is enough for a lot of those people to wait and just wait longer to fulfill those life needs. Therefore, I think the affordability ceiling in Denver is right around that $700,000 range for most people. And you have to think about the mindset of a first-time home buyer who has never had a previous experience with other interest rates. They're basically accepting the interest rates that there are now, looking at buy down options to try to buy the rate down if they can, and get a good deal in the marketplace right now. I feel like it is a good deal, when a seller's coming down in price a little bit, paying some closing costs, and possibly doing a rate buy down. Compare that to a move-up buyer who already had an interest rate locked in for maybe 5 to 10 years of homeownership. That was a very low rate. They saw lots of principal every month on their statement going away, but the interest was very low. Or nowadays, when they talk to a mortgage lender and they learn what they would be paying monthly for their new house, a lot of times this is the stopping point where these buyers decide, nah, this isn't for me. Let's wait till next year. Let's see if market conditions are better next year. Can't tell you how many times I've heard that in the last 12 months. So what does this mean for the overall health of the market? Well, it's interesting. If that price point continues to elevate in value, meaning the 600 and below range, those types of homes are now becoming more valuable, while the homes that are much bigger and better are stagnating in growth. What it means is, if you can afford a little bit more, you may be able to get twice the house right now, or you may be able to get twice the yard right now, or you may be able to get lots more updates right now, just for $100,000 more, or maybe $200,000 more. So it may be a time, if you do have a real need that you're going through right now and you need a bigger place, or you need something that's better or in a different location, this may be one of the best opportunities right now to be a buyer, because you are special in today's market. Sellers are welcoming offers from people who actually want to make that move up from their current home, and you can do it contingent on selling your current property, which is another huge perk in today's market. So keep in mind that a 1% interest rate change has a much larger dollar impact on a large loan of like $1 million compared to a smaller loan at $500,000, making high-end buyers more rate sensitive. Also, those entry-level homes, they still fit within the budget constraints for a large portion of dual income households in Denver. First-time home buyers often have a greater sense of urgency to enter into the market because they're excited to start building equity. Higher end buyers, or second or third time buyers, often already own a home and they can easily afford to wait for better conditions or for the perfect property because they know what they don't like and they know what they like. The split comes down to 3 things: math, affordability, and psychology. Understanding all of this is great, but what matters is how you actually use this information. So here's your strategy for buying or selling in Denver this fall. So if I'm a buyer in the $600,000 range looking for a single family home, I'll be buying with confidence, knowing that that segment of the market is still growing right now. I would also have caution in that you may run into some competition. You may run into some competitive scenarios right now. And so buyers in that 700 plus category, I would be looking at those opportunities to look at the tier just above you if you can afford it, right? I want to stretch anybody that can't afford the payment, but if you can, just take a peek at what you can get at that next level, because you may be shocked if you can double your house or double the size of your yard or the amount of upgrades that you can get. That may be worth it for you to add another couple $100 to your payment. For buyers under $600,000, be prepared to act fast. Have your pre-approval fully underwritten with your lender. That will be a requirement from every listing agent that you talk to. Competition is still pretty good out there for these types of properties, so be prepared to compete a little bit on the good ones. If you want something turnkey, that's a much higher likelihood of you competing. If you're willing to put some work into a property, you may not have to compete as much. For buyers that are over $700,000, be strategic and patient. You have negotiation power on price, inspection items, and closing dates. Don't be afraid to make a strong offer on a home that has been sitting for a while and ask for rate buydowns. For sellers that are priced under $600,000, price it right from the start. A clean, well-staged home priced at market value will sell quickly in that price segment. Overpricing by even 5% can cause you to sit and get way less money for your home down the stretch. For sellers that are over that $700,000 price point, preparation is everything. You need a professional for staging, photos, and a marketing plan. Be realistic about your price and be prepared to negotiate and wait. It may take longer than you think. Whether you're buying or selling, the strategy completely changes depending on your price point. The old rules no longer apply. If you want to know how to play it right this fall and use the split market to your advantage, let's talk. All my contact information is in this description below. Give me a call or send me a text and we can build a custom plan for your specific situation. Now, if you want to get a deeper look at what's really happening with Denver's housing supply, you need to watch my next video. Inventory hits a new high, the Denver real estate market update. I break down the numbers and what they mean for buyers and sellers and where the best opportunities are right now. Go ahead and click on it and I will see you there.